the United States and China effectively say that we are rushing to accumulate this stuff and classifying things as critical and openly using it, like the BRICS are, as a settlement vehicle instead of treasuries. In other words, use gold to settle imbalances in trade and in currency. That's part of the M-Bridge. That's part of what they're doing with the expansion of the Shanghai Metals Exchange. They're opening vaults all throughout the Belt Road. Gold is being integrated into the monetary system globally, and silver is just flat out critical for a world that is advanced. And I think they are prioritizing that now. And that is what's different, is that now it's not as big of a secret to the people who are pulling the strings as it once was. And these countries are significant enough in wealth and in sophistication to challenge this hegemony that where no one stood for delivery. And if you do, you break the system. And that's starting to happen right now.
The global financial landscape is fracturing as superpowers race to secure critical minerals and reintegrate gold into the monetary system. Both the United States and China are openly prioritizing physical accumulation, while the BRICS alliance is moving to settle trade balances in hard assets rather than U.S. Treasuries. This pivot is supported by the expansion of the Shanghai Metals Exchange and the strategic placement of vaults throughout the Belt and Road Initiative, creating an infrastructure where gold replaces debt as the ultimate settlement vehicle. By rejecting unallocated paper contracts in favor of physical delivery, these nations are dismantling the long-standing hegemony of Western derivatives markets. Andy Schectman, president of Miles Franklin, argues that this coordinated shift is a sophisticated challenge to the status quo. He notes that as sovereign powers align to demand delivery, the systemic suppression of precious metals is cracking under the weight of real physical demand. Now, we present the clips from Andy Schectman's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
We didn't see contracts standing for delivery. That didn't start happening until 2020. At that point, 1% of contracts were standing for delivery. And the countries like China and Russia and India weren't taking delivery off of the LBMA the way they are right now. And you didn't have the same environment. We still had, that moral high ground. We still had dollar supremacy. We still had all of the stuff that the United States was all about, right, in 2011. And so it was a situation that ended very abruptly and very quickly by raising margins. But now you're dealing, instead of sophisticated, savvy investors, you're dealing with nation states, in my mind. That's the real big difference, is that you have a whole world of big money that does not want to hold their wealth in U.S. Treasuries anymore. I mean, imagine if you have $1 billion. Where do you put your money throughout the last 30, 40 years? You put it in Treasuries, because that's the safest, most liquid place. You're not going to put it in the stock market, which has volatility. You're not going to put it into, you might buy a bunch of real estate, sure, but that excess cash would go into U.S. Treasuries. And that's where all that money went before. And now that money that has left U.S. Treasuries is looking for a safe place to put it. Well, you have a tier one asset that has no counterparty risk, that has doubled the performance of the 10-year Treasury over the last 25 years. And look at it the last few years. Last year, gold's up 40%, the Treasury's up 4.5%. And they had just got done, sanctioning Russia and confiscating theirs. This last year, gold's up 80%. 10-year Treasury up 4%. That's 20 times. So the point of it is there's no counterparty risk. It outperforms it. I think that is the difference, is that you have countries that are saying, we have enough money. You can't do that to us. You can do that to a hedge fund or to some traders. Go for it. Try doing it to the People's Bank of China, or try doing it in a sovereign-based hedge fund that works on their behalf, or try doing it to Saudi Arabia or to India. Any of these big countries have pocketbooks and checkbooks and intellect and coordination and motivation and sophistication that they didn't have, or the desire to challenge the West. And this is the way to do it, to challenge the West in a very docile way, if you will. And you don't need to fire missiles and bring your warships to the coast of New York to threaten the U.S. You just need to create an event where you get one of these massive banks to failure to deliver. And I think that's what's happening also right now with the European banks, because they're the ones supposedly on the hook. Now, that's Tom Luongo's theory. But if you look at a report that just came out of the Economic Times, they claim that JP Morgan has flip-flopped and has went long, has covered a 200 million ounce short position in silver, bought 20 21 million ounces over the last 6 weeks of Fiscal. And largely they and the rest of the U.S. banks, the big five, are long, leaving one or two of the banks in your neck of the woods and a couple in Europe massively short. So as the price goes up, who is getting squeezed on this? This is a very different deal than it was in 2011. This is about national sovereignty. And when you have the European Union, the United States, and China effectively say that we are rushing to accumulate this stuff and classifying things as critical and openly using it, like the BRICS are, as a settlement vehicle instead of treasuries. In other words, use gold to settle imbalances in trade and in currency. That's part of the bridge. That's part of what they're doing with the expansion of the Shanghai Metals Exchange. They're opening vaults all throughout the Belt Road. The first one was built in Hong Kong, where if gold leaves China, has to come out of Hong Kong. Well, the way they're doing it is they're trading their digital yuan over the SIPs or the bridge to a country like Saudi Arabia, getting their oil, and that digital yuan is now immediately convertible into gold off the Shanghai Gold Exchange in Hong Kong without converting to dollars. Guess where the second exchange is being built? Saudi Arabia. And they plan on doing multi-jurisdictional vaults all throughout the Belt Road, creating a system where you trade in local currencies, settle imbalances in gold. Gold is being integrated into the monetary system globally, and silver is just flat out critical for a world that is advanced. And I think they are prioritizing that now. And that is what's different, is that now it's not as big of a secret to the people who are pulling the strings as it once was. And these countries are significant enough in wealth and in sophistication to challenge this hegemony that where no one stood for delivery. And if you do, you break the system. And that's starting to happen right now. So going back to who's standing for delivery, these people do not use margin at all. These are at the low end of it. It would be Tesla and Samsung and Sony. And Samsung supposedly just went to Mexico and opened up a mine that had been shut to buy all their Dorian concentrate. As a side note, China's been doing that for 2 years. I've talked to Sean Kuhn and talked about this forever. Dolly Varden. He said, yeah, China's coming and buying Dorian concentrate right from the miners, have been for the last 2 years, paying double what the West will and shipping it back and refining it there. So the big players who are standing for delivery, they don't give a crap about margin. And that's the textbook for the CME group, the COMEX. Whenever there's too many longs that are threatening the shorts, they raise margins. But, I went to lunch with one of the owners of a professional baseball team 2 weeks ago, and he lives not too far from me in Florida in a neighborhood that I've never seen anything like it. And Mark Wahlberg is his neighbor, just moved in, and Alicia Keys down the street. These houses are $50 million. You think they use mortgages, or do they come in and pay cash? If rates on mortgages go way up, is it going to affect that neighborhood? No, but it will affect everyone else's neighborhood. So let's look at what they did. On Christmas Day, you needed $21,000 in your account, in your margin account, to control one 5,000 ounce silver contract, and say silver was $60 then, $300,000, 21,000 controls 300,000. So you get all these traders that say, and maybe they're well heeled. Maybe they have 10 million bucks. And they say, look, man, we can get rich. Those prices going to the moon. Let's go deep into margin. We'll buy all these contracts because we only need 21,000 in our margin account. So they do that. The next day, the CME group says, you now need $27,000 in your margin account. Raise it by 30%. So all of those contracts, if they didn't have the liquidity to put it in, they had to sell contracts to come up with the margin, which drives the price down further. Selling begets selling. The rise in margin and the selling begets more selling. Who comes in and scoops it all up on the cheap? Oh yeah, the big boys and girls that are standing for delivery for billions and billions and billions and billions and billions every month. They laugh. If you think you can play in this sandbox, your checkbook's not as big as ours. You may drive a Ferrari and have 3 houses, but it ain't as big as ours. So we're going to shake those bushes as much as we can. And anyone on margin's got to cough it up or get out. And so all of that drove the price down, and look at it today. It's at an all-time high again today. It's just shaking the bushes. Didn't change anything fundamentally. And that's really what's different about the deliveries. Is that in 2011, when they did this, they broke its neck and it never came back. It did not come back for 20 years almost, or 15 years, right? But now, whoever is standing for delivery looks at that as a gift, because all it is a leverage event where they deleverage the weak hands, and they come in and scoop it up, because what did not happen was all of a sudden, a big rush of supply into the market. That didn't happen. Nothing fundamentally changed, but the traders that were on leverage, well, they got had, and they got shook from the bushes to the delight of the big money who says, thank you very much for the $10 drop in the price of silver. Appreciate it.
The mechanics of price suppression via margin hikes are losing their efficacy as the market transitions from speculative paper trading to relentless physical accumulation by sovereign powers. In 2011, raising capital requirements successfully broke the rally by forcing leveraged investors to liquidate positions. Today, however, this tactic merely serves to shake the bushes, flushing out retail speculators while offering deep-pocketed nation-states, who trade with cash rather than credit, the opportunity to scoop up physical metal at discounted rates. The big money standing for delivery is immune to margin calls, fundamentally altering the market's reaction function. He argues that recent volatility is simply a transfer of ownership from weak hands to entities like the People's Bank of China, which view these dips as gifts. Unlike the paper crashes of the past, these sell-offs no longer dent the long-term trend, as physical demand from the East continues to absorb every ounce the West sells. Let's get back to the interview.
The U.S. government has classified it a critical mineral. The European Union did at the end of 23. China said in November they're going to prioritize their silver for domestic needs. And then a month later, in response, or 2 months later, in response to us saying it's critical, well, we're going to limit exports. You have the LBMA, which, according to David Jensen, which is someone that I think you should have on your show, he's fantastic, who says there's 2 billion ounces of contracts that are outstanding that are deliverable contracts against a 140 million ounce float. And he questions even that amount. In other words, those 140 million ounces have obligations of 2 billion ounces that they're backing. What could possibly go wrong? You're seeing every single month for the past 15 months since Trump won the election. I'm not kidding. Every month, millions and millions and millions of ounces every month, billions and billions and billions of dollars. And really, what more do you need to know other than who the hell's doing this? Who is bringing in billions upon billions? And at that level, when you're talking that kind of money, these people don't do things just for the hell of it. They know where things are going. They are friends of or are the folks that make the rules or write the playbook. And when you see a market where 8 Western banks, 1 or 2 in Canada, 4 or 5 in the US, and 1 or 2 or 3 in Europe, have controlled the largest short position on COMEX of any commodity ever traded in the history of the market, over 1,000 commodities, that's now breaking. It's breaking because these commodities all have delivery, these contracts have delivery features that no one ever did, less than 1%. Nobody did. And it was a market to hedge or to speculate. We use it. If I have 3 million ounces in my warehouse, I'll sell 3 million ounces on paper. So I'm market neutral with my inventory. But what it has turned into is something far more than that. And it has given the ability of the West to suppress gold and silver. And I would argue silver, because of the military-industrial complex, the amount of silver that is needed in high-tech weapons. Go to silverwars.com and read what they say about all of the military uses of silver. And then look at gold, and it's a term called Gibson's paradox that speaks to the inverse relationship between real interest rates and gold. So the West wants to suppress interest rates, they got to step on gold. No one ever stood for delivery, but it started in the global South. It started in 2020, where all of a sudden we started to see huge deliveries and repatriation of gold and silver by central banks and by very large purchasers. It's now accelerating. And when you have, just like Bernie Madoff, everyone was happy with the monthly checks they were getting until people said, you know what, I need my principal back. That's what's happening on the LBMA. That's what's happening on COMEX. You're seeing far more deliveries than there are bars, or far more delivery requests than there are bars to handle it, far more paper contracts than there are bars standing behind it. That is what is fundamentally different. And I think that's all you need to know is who the hell is standing for delivery for billions and billions and billions and billions and billions in silver. The U.S. government just put a national strategic national security policy floor underneath the price of silver. The public has just begun to wake up, but really hardly at all. They're just beginning to. Not the people watching this this has been common knowledge forever. So this isn't being driven by the retail public. This is being driven by the most well-funded and, far more important, the most well-informed traders on the planet. And they see something very clearly that is allowing them to spend hundreds and hundreds of billions of dollars to bring all this stuff in. They don't do it for the hell of it, as all of these countries do not want to hold treasuries anymore because of the risk of sanctions, because of the military risk, because of the irresponsibility. Why would you want to sell your oil to a country where the dollar is being wickedly devalued through fiscal irresponsibility. And the metrics that they use to tell you how much inflation and how much money creation are completely fugazi. Right? They don't even publish M3 anymore, and they said it was archaic, but that's the broadest measure of the money supply. And the CPI the CPI should be called the CPI. John Williams of Shadow Stats would say it's 11%, not 3. So all of these things that we are doing, on top of the way we're going around the world doing all of this stuff, I think only reinforces the likelihood that they're not going to hit a roadblock. Look, they're not perfect, but I think, and everyone says, who will trust China? It's not about who will trust China. Everything that they are doing is based upon transparency, based upon gold, based upon using your own currency over a network that isn't going to be interfered with by the SWIFT. So I would say there's a 60-70% chance that there isn't something that derails them. But is it fast enough for the people who analyze this stuff to agree with it, or do we just get blindsided by it someday? I don't know. I guess that's the question, because we get no credible newsworthy anything from the mainstream. It's people like me who sit and either too stupid to say it or have the courage to say it because I believe it. We'll see what happens. I've been doing that for 5 years, and a lot of it's come true. I'm not happy about that either. It's frightening. I got 3 kids, but they're growing up in a world where the dollar is not really looked upon, or is this country looked upon the way it once was. Hopefully we get our act in order, or else things will change. And that's just the way the world works.
The breakdown of the paper silver market signifies a return to counterparty reality, where the urgent need for return of principal replaces the monthly checks of the derivative system. Just as the Madoff scheme worked until the redemption requests exceeded the cash on hand, the precious metals exchanges are now fracturing under delivery demands that far outstrip available inventory. This is the inevitable consequence of a system that sold billions of non-existent metal to suppress real interest rates and mask the currency's devaluation. This structural failure serves as a stark warning that the era of paper promises is over. As the illusion of abundance fades, the market is repricing to reflect the actual scarcity of critical minerals. The future belongs to those who hold the asset itself, rather than a claim on an empty vault, as the world moves relentlessly toward a system where value is defined by weight and purity, rather than faith and credit. Share your thoughts on his analysis in the comments section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.